Hello, thanks for clicking through. It's Steve Kalem, Senior Mortgage Banker with US Bank. I felt I wanted to get this video out because I read an article in the Wall Street Journal this morning talking about how the Fed's efforts to reduce inflation have really not been successful to date. They have not gotten a lot of traction, even though they've increased the federal funds rate several times. And while most economists were projecting that we were done in this cycle of increasing rates, now it's projected that the Fed will increase rates this month, probably next month, and who knows on from there. So rates will continue to increase. Now, it also talked about sellers throughout the country dealing with solutions to this situation, temporary buy downs and permanent buy downs, and how to address that. We have not had to deal with that or resort to that in our market as much, but let's face it, if rates continue to go up, people who qualify and who were qualified in the beginning of the year and are still qualified will be priced out of buying a home. And while our inventory is limited and that homes will continue to go up in value, if you can have more people qualified to buy your home, then there will be more people pursuing that, and potentially you'd be able to get an incremental value if you're a seller. If you're a buyer, it's a no-brainer because you reduce the payment, which is the most important during the first couple of years or throughout the life of the loan. And that's really what drives the cost of home ownership, the monthly payment. Let me share my screen so I can quickly walk you through this. And if you have questions, we can have a conversation. Please call me. I've got 4 vertical columns. They illustrate the purchase of a home for $1,250,000 with 20% down. And column 1 is today's market price for interest rates. And you see it there, 30-year fixed, and what the payment would be, including taxes and insurance, and what the cash to close would be. This is a DC property. Okay, so now column 2, creative solution number 1. If you're a seller and you choose to contribute $25,000 towards a buyer's closing cost, the amount is based on the loan amount. So you're contributing $25,000. Now, if you're the seller, you're selling your home, netting out $1,225,000. That's 98% of the list price. Or if you're in a negotiation and you can raise the interest rate, or I'm sorry, raise the purchase price to accommodate that extra $25,000 for the same. In any case, look what it does to the rate. It drops at 1 3/8%, which reduces the payment almost $900 a month. That's $11,000 a year. Over 5 years, it's almost $30,000. But more than that, if you follow the arrow, it allows people to qualify who couldn't qualify if you're earning $24,000 or so less a year or $2,100 less a month. Now you'd qualify in today's market. And if rates, like I said, continue to go up, then you're going to increase, if you're the seller, the amount of people who can buy your home. So this is something that you may want to consider. Another alternative, if you're the seller and if you're a buyer, is to do what they're calling a temporary buy down. You're reducing the interest rate 2% from the start rate the first year and 1% the start rate to the second year. So again, look at column 3 for 98% of the purchase price, or rolled into the purchase price and maybe for even higher than your original list price. A buyer would be at 4 1/8 the first year, and the payment would be $1,639 less per month, $20,000 for the first year. The second year it would go to 5 1/8, so that would be $820 less per month. So in the 2 years, a buyer would save just short of $30,000 in actual payments, and it gives them that window for the cycle to work itself out, for the Fed to reach the peak, for inflation to become tame, and for rates to start to come down. If it doesn't happen, that buyer would have a 6 1/8 rate, which is a great rate in today's market, but they most likely will be able to refinance and reduce the rate. Okay, the last column is a combination of both in the column 2 and 3. Do the permanent buy down and do an interest-only loan. That minimizes the payment, and you go down there, you see that would make the payment $2,000 less per month for a buyer. Now, this is a great situation if you're a buyer who's going to sell their house after you end up buying a new house. When you sell your house, you take the proceeds that you had budgeted and you pay down the new loan, your payment would immediately drop. The interest rate is 5 3/8. It's a great rate. It's an incredible rate in today's market. And you don't have to make the interest-only payments. You can make a fully amortized payment, which makes it a normal loan at 5 3/8. Or if you choose and you're getting bonuses, you can pay the principal, the payments at the end of the year or whenever you get your bonus. I'm going to stop the share. Please let me know if you have questions. These are incredible solutions. Again, we probably don't need it that much now, but as rates continue to go up, this is a great thing for you to consider if you're a seller, to maximize the potential of selling your house and quite honestly, the profit that you can gain out. And if you're a buyer, to maximize the affordability of the new home, get that home, allow it to appreciate. You're getting an appreciating asset and you're paying so much to harness that asset and get the growth over time. Okay, thank you very much. Please give me a call if you have any questions, and I hope you have a great day. Take care.